You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast.
All right, welcome back, everybody. Welcome back to another episode. Brandon, how are you doing? I've got some, actually, before you say how you're going, I've got some inflation updates because I'm sure people aren't sick of that. Eurozone inflation hit 5.1%, which was up from 5% in December, and they were expecting a decline, actually, from December to go down to 4.4%. So,
and they didn't get it.
No, they didn't. Surprise, surprise. What they expected didn't happen. So, yeah. All the other.
I'm doing well. You know why I'm really doing well is because I've been staring at Google Maps for the past half an hour because myself and Hamish, if we can make it happen, we're going to try and go to the Berkshire Hathaway annual shareholder meeting. That's what we're going to try and do. Whether we're successful or not, who knows? Apparently we have to be a shareholder, so we have to buy one. We're going to buy a B share each. And then we have to find some sort of form that we have to fill out.
Yeah, keyword try.
There's a couple of hurdles to get through, but we've made a mental commitment to try and go to the Berkshire Hathaway annual shareholder meeting this year.
So if anyone's
Can we do it?
Yeah, so if anyone's got Buffett's number, just shoot that over to us. And then, hey, buddy, got a seat up front for us?
Are we after that CNBC interview, are we still good to record our little collab? Are we good for that? for the YouTube channel? But no, man, I really hope we can get this done. I really hope we can do it because that would be fantastic.
Oh, yeah.
Yeah. And if anyone maybe in our listenership is going or plans to go, let us know because I'm sure we could do all sorts of stuff. We could do a little party or something over there for the Berkshire Hathaway shareholder meeting. But no, that will be exciting. And then of course we just after we committed to that, then we just started holiday planning, didn't we? We've been talking for about half an hour just holiday planning.
It's exciting. This
business trip.
Yeah. Sorry, business trip. Yeah. No, there's so much of the States I haven't seen. So, and you haven't been at all. So, there's a lot of ground to cover that we could, a lot of different places we can go. So, yeah, I'm excited.
Fill up your water bottle, get your shoes on, put it on your sneakers, and let's go. But anyway, so that's a bit of our daydreaming. But podcast today, Facebook, Google, Apple. We didn't talk about Apple last week, did we? We ran out of time, didn't we?
We ran out of time, yeah.
So Apple, and maybe we might get to Spotify. Interesting stuff going on with Spotify with all that Joe Rogan controversy at the moment. So earnings, and more earnings. And we're going to try and get to some Q&A as well. So we'll see how we go, but we do have a lot to talk about.
Yeah, absolutely. We better get straight into it. So today's episode is sponsored by Sharesight, which is an application you can use to track the performance of your stock portfolio. So you can bring in all of your trades either automatically by connecting your broker, which most brokers kind of work with Sharesight, or you can do it manually if you want to do it that way. That's what I do. I download the trades through Excel from my broker and then just manually upload them. So that way I don't have to connect my broker. And once you do that, it will basically track all of the different types of gains and losses in your portfolio. So capital gains, dividends. If you have dividend reinvestment plans, it will do all of those calculations for you. Currency gains if you're buying shares internationally or you hold foreign currencies. And then you can also use it for when it comes to tax time and also performance tracking. So Sharesight generates up to 12 different reports that can be used to track your performance, diversity, that sort of thing, as well as at tax time to work out things such as capital gains, dividend income, and more. And at the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. So use that link, sign up to a free plan, track up to 10 holdings for as long as you want, or you can sign up to a premium plan. And if you use that link, you'll get 4 months off a yearly subscription. So go check it out if you're interested.
Absolutely. All right. Where should we begin? We should definitely, as you said before, we'll do Facebook and Google back to back. Do you want to run through Facebook or do you want me to run through Google?
Yeah, I'll run us through Facebook. Facebook, certainly, as you'll see, relative to Google, had a much tougher quarter.
Really?
Over the past 3 months. So I woke up this morning and Facebook stock is down 20% in after hours. So big decline. I don't know what Google did, whether it was down a little bit or up a little bit, but Facebook certainly felt it heavily. And that's kind of a similar trend to what we've seen with a lot of tech companies, weak guidance into the next quarter, that sort of thing. But to give you some Q4 results first, and then we'll jump into the full year results and what's going on in the business operations wise. Revenue came in at $33.6 billion, which was up 20% year over year. So still
solid.
Pretty solid growth there. And now Facebook breaks their business down. Previously they would break it down into advertising and then just other. So they just lumped, payments and their Oculus business all into the other category. Now they do things a bit differently. Now they have family of apps, which includes all of the different revenue streams from Facebook, Instagram, WhatsApp, Messenger, which is still primarily advertiser revenue, 99% advertiser revenue, but a little bit of payments. So they've separated it like that. And then they have a category for Reality Labs, which is their VR, AR, and metaverse businesses. So revenue for the family of apps came in at $32.8 billion. And from Reality Labs, it was $877 million. So their, VR, AR business is, of course, still very, very small, still in infant stage, for sure.
But I guess that's what they've been talking about for the last, particularly few months, I guess, is to the next phase of their growth, I suppose, is to focus more on these reality labs and metaverse and VR and AR and that sort of thing.
Yeah. They definitely.
But
go on.
I was just going to say, but it's definitely a stark difference at the moment when you're talking about the 4 apps generating $32.8 billion of revenue versus $877 million from Reality Labs. It's just like, well, it's kind of funny because all this talk has been about reality, virtual reality, metaverse stuff, but it's like, well, when you actually look at Facebook or Meta, as we now call them,
true.
It's quite insignificant, and that's always been the case. Like I remember when they used to report it like advertising and other, and advertising would be like 98% of their revenue.
Yeah.
So
and even in that 2%, you had payments, which was probably 1%. So Reality Labs has been and AR VR has been a very small part of the business, but it's of course where they're investing a lot of money at the moment, and they see the opportunity there to expand to improve those products. So people can use them more regularly. At the moment, it's kind of quite trivial the way that people use tech companies, weak guidance. There's really no good AR devices, at least from Facebook. But Facebook wants to see that VR can improve and that it can be used more regularly, like for work, and you can just have one on your desk and put it on your face, and everyone who works at that place can jump into a virtual meeting. And it's a little bit more engaging than just being on Zoom, sort of thing. So that's the direction they're heading, and it's reflected in their operating income, where we can actually see, the dollars being pumped into these two businesses. And this is why they separated it out as well in this way, so that you can see what's the profitability of the family of apps, of their social media platforms, and then what's the profitability of their VR investments, because those two things are very, very different. Operating income for the family of apps came in at $15.9 billion, which gives them approximately a 50% margin there. So insane business, that one, continuing
crazy.
to grow. And then you jump down to Reality Labs, and they took an operating loss of $3.3 billion. So, $900 million in revenue, $3.3 billion loss. You can see, they have $900 million in revenue and about $4 billion worth of expenses just on that business. So, they're obviously pumping a lot of money into that segment.
Yeah, and that's how these things always start when an established business gets into a new area or does something different. They always kind of separate it out on their financials and they say, look, we're going to be investing heavily. It's kind of in the experimental stage when they're just trying to figure out what their product is. Kind of funny because all the technology is how they're going to label it in a new industry. They'll kind of separate it out and say, look, we're working on it, but it's obviously, it might be a big thing in the future, but for the time being, it's not. So you always see these things run into the negatives. Until hopefully one day they become their own standalone kind of profit machine. But it could be the case that maybe Reality Labs section never actually becomes very profitable. Maybe that's like the next foundation for the family of apps to become even more profitable. So maybe it's like a structural thing. I don't know how they're going to report this in the future, but maybe their idea behind we need to work on the metaverse and blah, blah, blah is because that's where they see the foundation of the internet or the structure of the internet headed, and they want to make sure that they're a key player in that so that Facebook, Instagram, WhatsApp, Messenger, whatever they mold into over time with the metaverse kind of, I don't know, whatever it might turn out to be. Maybe they treat Reality Labs as a not really a hugely profitable foundation structural support for the continued future growth of the family of apps. That might be a way of looking at it. I don't know. Like, this is all yet to be determined. Like, remains to be seen. But,
it is very interesting because a lot of what they're doing is very far out, and you can kind of think of it like, it's not really the same, but you can think of it like Apple and their iPhone and then the App Store. Before people, there was so many. The iPhone had to reach a point where so many people were using it in order to really activate the services revenue that they can churn out of the App Store.
Yeah.
And it's kind of similar to that. Obviously, it's very hard. There's not much visibility at the moment with how popular VR will be and how it will be used. But if it can reach a point where everyone has one on their desk for work, or a combination of work and entertainment, then that activates significantly the spend in the Oculus Store for different kinds of work-related, social and entertainment services. And I think they said that I don't know if this must have been for the full year. I think they said $1 billion was spent, maybe it was for the quarter, but they said $1 billion was spent within the Oculus Store. That's not all going to Facebook, of course. Most of that's going to the developers. But that's really, I think, where the business lies. It's like a little bit on the hardware. Can they push the hardware out to a lot of people, make it accessible to a lot of people and desired by a lot of people? And then can they activate significant services on the back of that? I think that's kind of what they're looking for. But in terms of the family of apps, it's always important to look at how many people are using these services. So family of apps refers to all of their apps now. They combine them all together. So that's Instagram, WhatsApp, Facebook, and Messenger. In terms of the daily active users on those apps, it reached 2.82 billion, which was up 8% year over year. A lot of that growth, I believe, was from WhatsApp and then also Instagram through increased adoption of using Reels within Instagram. Monthly active users on the family of apps reached 3.59 billion, which was up 9% year over year. So
yeah, it's pretty big, isn't it?
They've really had, particularly with the family of apps, it's been a very consistent, 6 to 8% per year growth in those areas for a very long time. I feel like I've been saying 8-9% every quarter for a while now, maybe a little bit higher previously, but there's still a big growth rate, almost a 10% increase.
It's impressive.
What's that? Another 350 odd million people beginning to use their apps on a monthly basis, and 250 plus million using it on a daily basis. So very impressive growth.
And if they can maintain if we look at things in like absolute terms, with how many people does 9% growth equate to, it's still impressive because obviously, they're in absolute terms, they're adding more and more and more. Even if they keep a 10% growth rate, each time they grow 10%, that's a step change in the absolute number of people that have joined up. So yeah, it is pretty mind-boggling just how it's like we go back to the joke of like it's Mark's fake accounts, but it actually does make me think like it's so saturated. Where do these people come from?
This year we had 9.4 billion daily active users. Hang on, Mark. There isn't that many people.
Yeah, exactly.
It
was actually, just to bring that up, in the CNBC write-up on the Google earnings, there was a point in there that made me laugh because they said something like,
it was 15, I think.
They said on their conference call that YouTube now has 15.2 billion monthly active users. I was like, that's interesting.
I scrubbed over that. I was like, oh yeah, 1.5 billion active. Wait, 15?
yeah, you saw that as well.
Yeah.
15 billion monthly active. I was like,
my goodness,
interesting. We've been having a lot of babies lately.
Yeah, what the? That's funny.
Clearly a typo, but it did make me laugh.
Yeah. Oh, so right. I just took it as there's multiple like users, like people have multiple accounts, kind of thing. So they could actually exceed it. Yeah. But it was a typo.
No, when I listened to the conference call, it was a mistake. What they meant to say is that there was 15 billion views per. I think it was actually the number 15 was not that I'm skipping ahead into. I will talk about this. But the number 15 was related to 15 billion views on YouTube. I think it might have been YouTube Shorts each day.
Wow. That's crazy.
So, yeah, they did stuff that up. But anyway, sorry.
Sense. No, but
back to Facebook.
But you do raise a point. I mean, obviously there's some level and probably a substantial level of overlap on accounts there. That's not 3.59 billion individual people. A lot of people have duplicate accounts. There's a lot of fake scam accounts. So what the true number really is I think very difficult to assess. But continuing growth there. They still provide numbers on just Facebook, so just the Facebook platform. Daily active users hit 1.93 billion, which was up 5% year over year, and monthly active users 2.91 billion, which was up 4% year over year. So growth on the Facebook platform itself is really slowing down now, and that makes a lot of sense. I mean, people are transitioning away from using Facebook's newsfeed to really it's heading over to Instagram and Reels, or to even to other social media platforms like TikTok, which have taken a lot of
definitely the trend in social media is the ultra short form content. But it is interesting. I mean, it's like everything. Growth is not linear. Growth is an S curve. It's normally slow at the start, then it catches on and it ramps extremely quickly for a period of time, and then it tapers off at the end. And that's normally when companies start paying dividends. They just become cash cows essentially, and maybe that's just what Facebook will turn into. I mean, they've probably captured the vast majority of people they're going to capture, and now it's just about making sure that the service stays relevant and they can still keep making a lot of advertising revenue from it, and just reward shareholders with the amount of profit that Facebook generates.
And I'll talk about that in a little bit, because they activated some serious share repurchases. In 2021.
I didn't even know. Right, there you go.
But before we get to that, they added a couple of new metrics that they didn't previously report. They now report ad impressions, so how many ads are served in front of people, and then the price per ad, which I'm really excited that they started to do this, because those are the same. Well, Google gives pretty similar metrics to that as well, so you can do kind of more of an apples to apples comparison between increases in ad impressions and prices. But in the fourth quarter, impressions rose 13%. And the price per ad rose 6%. So that's kind of where growth is being driven on the revenue on a revenue basis, mostly coming still from more people consuming more content, therefore being served more ads, and then a little bit on the increase in the price per ad. And then in terms of the full year results, revenue came in at 117.9 billion, which was up 37% year over year, and marks the first year. Mark
Zuckerberg's the first year.
First year they hit 100 billion in revenue. So
wow, okay,
good job, Facebook. Got over that big milestone. I don't know how many commas that is. Operating income came in at 46.8 billion, which is up 43% year over year. So on an annual basis, their profit margins continue to expand, but investors weren't happy. And the reason they weren't happy was because of not really I don't think too much to do with those financials, but mostly due to the guidance given for the next quarter. And we saw this, heavily with Netflix a couple of weeks ago, where they actually did a pretty good fourth quarter. It was one of their highest of all time. And then they guided forward really weak and the stock got smashed.
Right.
And that's pretty much what happened with Facebook. They're expecting 3 to 11% revenue growth, which is a pretty big margin.
That's a drop.
Yeah. So yeah, I mean, it really depends on where they fall within that. And regardless, I mean, 11% is low relative to what they've hit recently. And
imagine if they came in with 3%.
Yeah.
That would be quite a shock to the system.
Yeah. It was kind of funny because the range of guidance for revenue was, I think it was 27 to 29 billion. So that's the difference between 3% and 11% growth. Like it's relatively small in terms of actual numbers, but yeah, it's quite a wide range. And if they hit 3%, you would imagine people would be very upset. And I think that's why the stock fell quite considerably. But yeah, Mark spent a lot of time talking about headwinds. And this is one of the things I actually respect about Zuckerberg is he doesn't gloss over the problems that are going on in the short term.
No, that's true.
He will spend a lot of time talking about it. And that's what he did. And sure, it makes the stock a bit more volatile than others, where the CEO is very salesy, but he gets to the point, and he spoke about a lot of things. He said that there's clearly increased competition for people's time, and that's hurting their impressions. So he spoke specifically about TikTok and how that's drawn away some of their impression growth. He spoke about a shift of engagement to Reels, which is hurting ad rates. So ad rates, the amount they can charge per ad on the feed was really, really high. That was kind of knocked down again when people moved to stories and Instagram feed and to mobile. And then it's also been hit again once we move to Reels, where there's even less in terms of the cost of ads. So as kind of consumers have shifted how they consume social media, that's been kind of a downward pressure, and that's continuing to hurt their business. Pricing continues to be impacted by a number of factors. He spoke more about Apple's iOS changes that were made last year that limited the tracking of your use of apps that Facebook can use to give you serve you targeted advertisements while you're playing games and that sort of thing. He spoke about macroeconomic problems. Hearing a lot from businesses that there's big cost inflation, surprise, surprise, and supply chain disruptions, which are causing businesses to pull back their ad budgets. So advertising is the first thing businesses pull back when they're struggling, because a lot of the time businesses are just spending a bunch of money on brand advertising and there's no real connection on what it's returning. So it's an easy thing to just chop out and immediately save some margin. So, and that wasn't even all. He listed probably another 2 or 3 or 4 things that were impacts and going to impact the business in the short term. It was quite an interesting conference call because he did spend a lot of time really, really kind of warming people up to the idea that it's going to be a tough year for comparisons. And that was... I
don't mind that. I don't mind. Like, obviously, nobody likes to hear, tougher news, but I do respect Mark Zuckerberg in a sense that he does talk about this stuff. You can tell that when he talks, like all of these guys, they're reading scripts. They've written down what they want to say already. And you can hear that particularly with Mark. I don't know, for some reason, Mark, he's got the biggest communication app on the planet, but he can't speak to save his life.
He's hopeless.
He's really bad. But he does tell you the things that as an investor you need to hear, whether they're good or whether they're bad. So I actually like it because that's what you, as an investor, I mean, he could just be a salesman, but as an investor, you don't just want to hear the good stuff. In fact, you can read about the good stuff. That's fine. You probably more want to hear about the challenges, the headwinds. So I much prefer that than if you listen to like Tim Cook. Tim Cook on the conference call is basically just like, I just wanted to thank everybody and respect and everything, equality and this and that, which is nice. And then he's just like record sales and income's up and everybody's really loving the new products and that's it. All right, thanks. It's just like politically correct stuff, sales stuff, buy our stock, love our company. And he never talks about any of the challenges.
Yeah. Interesting kind of different ways that CEOs go about it. And I mean, look, it makes sense. It doesn't make sense from an investment point of view, but a lot of CEOs feel the pressure of protecting the stock price, even though it might not be relevant to the business. I mean, Facebook does not need to access capital from the equity markets. Like, it doesn't really matter what the stock price is from their point of view, because they have so much cash. And that's, that kind of, I'm sure, plays a role in why he's so willing to speak freely about it. But the stock really has struggled a lot over the past 6 months. It hasn't just been this quarter. I mean, it's kind of trickled down for a while now. And they've been activating the share repurchases because of it. In the fourth quarter alone, they did $20 billion worth of share repurchases. And for the full year, they did $44 billion worth of share repurchases, which is massive. That's a huge amount to be spending on your own stock. So,
although because the stock's gone down recently, I'm kind of glad that more than half, or about half of the total full year was done in Q4. Was that Q4? Yeah. So that does make me feel a little bit, as opposed to Apple, where it's just like rain, hail, or shine, we're going to do $100 squillion of buybacks every quarter. Yeah. It's like, what's that? Our stock's pushing all-time highs? No matter. We'll do another 50 billion buyback. Easy. No worry. Double it. Make it 100.
Yeah, all right. And that pretty much wraps up Facebook. Nothing else kind of too much to talk about for them at the moment. Do you want to take us through the other side of the big digital advertising industry?
Yeah, absolutely. So we got Google, a company that's very near and dear to what we do for a living.
We love you, Google.
We love you. Don't change our ad rates, please. Please keep paying us.
And nothing went wrong with Google at all this quarter.
No, nothing.
Amazing
Google's
business.
great. You should buy the stock.
You know that fraud stuff you heard? Complete rubbish. Rubbish.
Absolutely. Bonkers. YouTube's the place to be forevermore. Anyway, no, Google, the stock jumped 9%. So investors liked what they saw. Oh no, it's this time of the quarter where I'm going to trigger my Google Assistant again.
Hang on.
Hang on. I'm just going to go put it in a drawer. Just give me 2 seconds. And we're back.
All right.
Okay, so you've got a Google phone as well, don't you?
I just realized I've got a Google Assistant on my desk as well. I better turn this one off.
Oh, no. Yeah, turn that one off as well. I'll just start rattling off some numbers. So revenue for the quarter, $75 billion versus $57 billion in Q4 last year.
God.
That's like revenue of $75 billion in a quarter, man. That's
monster
that's crazy. Yeah, and you were talking about how, was it 2021 revenue for Facebook was just first time over $100 billion? Oh, nothing, mate. Nothing. 2021 revenue for Google is $257.6 billion. But how crazy. We're talking big numbers, but that was also up 41% year over year.
That is off the charts. I mean,
that's off. Yeah,
I'm sure you're going to talk about the specifics of Google, but I'm almost certain that they've expanded their market share in advertising, and their ability to do it on so many different forms: search, YouTube with videos, on people's websites, through network marketing. It's just incredible business.
Yep. Synergies with hardware.
Yep.
There's so much. So there's just so many tailwinds rather for the business. So it's crazy. But we'll keep talking. So of that of their revenue, they maintained a 29% operating margin for the quarter. So and a 31% operating margin for the year. Net income was $20.6 billion for the quarter versus $15.2 billion in Q4 last year. And they ended the year, 2021 net income was $76 billion, so up 31% on 2020. Wow. So, insane numbers. Google's just a behemoth. It's a boss. It's ridiculous how strong they are financially.
Yeah.
And if we break down their revenue, something that I like to do as well. So 57% of their revenue came from Google search.
Okay.
11% came from YouTube ads. 12% came from the broader Google network, so ads placed on other people's websites and such. So that meant that total Google advertising was 81% of their revenue.
Wow.
So like with Facebook, most of their money is made, obviously, selling ads.
Yeah. My God. And YouTube is just becoming a larger and larger piece of that pie over time. I've watched that number go up considerably over time. It's fascinating to watch.
Yeah, absolutely. YouTube, I think, YouTube is a big opportunity for them in the future. And then, so moving on from advertising, cloud accounted for 7% of their revenue. That's interesting. Their revenue, and then Google Other accounted for 10%. So that's all their just miscellaneous Play Store, Chromebooks, Android, hardware sales, that sort of stuff. Pixel. But yeah, interesting. Just 10%. I'm surprised by that. I thought it was higher, but there you go. Clearly not. But how did each of these segments contribute to profitability? Well, cloud lost $890 million, but it's getting better and better every year. But this is what we were talking about before, how, newer kind of areas of business suck money until they, for a long time. Other bets lost $1.4 billion. There was $1.8 billion in corporate costs, and then Google services luckily kept $26 billion out of the $69 billion it generated. So that's where all of their net income comes from, I suppose. Overall, they generated $18.6 billion in free cash flow for the quarter, up from $17.2 billion in Q4 2020. And for the full year 2021, they printed $67 billion in free cash flow, up from $42.8 billion in 2020. So that is a substantial rise.
It's like a 50% increase.
Yeah, 42 to 67. That is not bad.
My goodness.
And similar to what we were talking about with Facebook, they're also in the Google's also in the repurchase mode. So they repurchased $50 billion worth of shares in 2021 as well. So giving back to their shareholders a little bit. Although I don't think Google, the stock hasn't gone particularly downward.
No, it was the best performing. I think it was the best performing stock out of the big tech stocks for the year. I'm pretty sure. I saw an article like that or something. It was up 65% for 2021. So
yeah, they really haven't. Clearly, they're not phased by doing buybacks at all-time highs, which interesting.
Yeah, and I mean, look, to be fair, it's not really relevant. I think it can be, but it's not always relevant whether a share price went down or had a dip or was like 20% below their all-time high when they did share repurchases. What ultimately matters is
it's down to value.
Yeah, it's down to value, right? So even if the stock goes up 65%, if it was really undervalued and now it's still undervalued according to management, if they still see that buying it back a share today is worth it because they're going to be producing much more in the future, then those share repurchases make sense. And that's kind of been, Apple's philosophy for a long time. And to be fair, they've continued to grow, and the shares they were repurchasing, they were doing a lot of share repurchases even, a couple of years ago. And those programs have done very, very well, at least in the short term for investors. So a lot of share repurchases. It's the method of choice for particularly the last 5 years for how companies deliver stock to or deliver returns to shareholders.
Yeah. Definitely. So, hey, I forgot to look up the paid clicks and cost per click. So you reminded me when you were talking about Facebook, but it's okay. I found it. Okay. So while you were talking about Facebook, I delved into their annual report and I found it. So for 2021. They had a 2% increase in impressions. Okay. Cost per impression was up 35%.
Wow.
Paid, that's pretty ridiculous, isn't it? 35%. So prices going up.
What do they call that when prices go up? What's that called again?
Yeah, I can't remember.
Term for
Look,
that,
these
technical
terms, I don't know.
We'll get back to you on that one.
Point. Yeah. In terms of paid clicks, they had a 23% increase in paid clicks. and cost per click increased 15% for 2021.
Okay.
I can't remember what you said with Facebook.
So Facebook actually saw bigger growth in impressions than the price per advertisement. So a little bit of a flip, but that's generally like the behavior that you will see. If there's a small increase, what did you say, 3% in impressions?
2% impression rise.
So when impressions don't go up, but you've got this massive shift still happening in the industry from traditional means onto digital advertising, it just means that there's less real estate available, but a lot of demand, and that drives prices up. So that's clearly what happened is that for the quarter, the 35%?
That was for 2021.
Yeah, so that's clearly what happened last year is they didn't see huge amounts of additional people using Google search and that sort of thing, which honestly makes sense. It's kind of reached its maturity. But clearly there's still a huge amount of demand of advertisers going, hang on, we're spending this much, we're spending X amount on cable TV ads. We could spend a fifth of that on Google ads and get the same amount of impressions. So there's that huge amount of money moving over, especially as those long-term contracts kind of run out as well for businesses.
Yeah, so very interesting. The amount of clicks went up and the cost per click went up for Google. So good to see for Google shareholders. I thought I'd tell you some of their balance sheet numbers because I always like doing this when we're talking Google because it's just mind-boggling. It seriously does boggle the mind. So total cash equivalents, marketable securities, bundle it all together, you get $139.6 billion.
Just a little bit.
Just a little bit. I actually went in because I was very interested on a per share basis. What would this turn out to be? If you split that number on a per share basis, that's $211 of cash per share on the balance sheet.
Yeah, and we've kind of spoken about this a little bit, how you can, when you're doing an analysis of what the business is worth, that's like the same as, the analogy I like to use, I can't remember who I originally heard it from, but if you're buying a house and there's $139 billion buried in the backyard, then that adds, at least $139 billion extra for what you're willing to pay for the stock, because you get that immediately. You buy the house, you get your shovel out, dig it up, and you get that as a discount essentially on what you originally paid. So you can think of Google in the same way. You might pay, I don't know what the stock's at, 2,000 or whatever it is at the moment.
2,700 even, something like that.
And you could just subtract the
2,900.
Wow. Yeah. Okay. And then you could just subtract the 211 because that's what you're, air quote, getting when you buy the business, and that's the real price you're paying. Well, you'd want to add debt as well, but I don't think they have much debt.
Yeah, that's exactly what I was going to get to next. So we had $139.6 billion in cash, marketable securities, cash equivalents. Only $14.8 billion in long-term debt.
Just a smidge.
That's literally like a fly on the windscreen, a bug on the windscreen.
Yeah, they don't have much at all.
Just insane.
No. Yeah.
Pretty ridiculous. Anyway, current assets of $188 billion versus current liabilities of $64 billion. So just a cool current ratio of about 3. No worries. Easy as you like. I mean, this is why people say, oh, why is Google stock so expensive right now? How many people have asked you that? Why is it so expensive? I mean, it's so expensive right now because they've just got the most boss balance sheet that there's such little risk of things going seriously wrong. For them because they've just got the money. Like at $14.8 billion, that's all right. They could just like take a tenner out of their pocket and get rid of all of their debts. It's like paying your mortgage off with the $5 bill in your pocket. It's like no worries at all. There's if you don't owe anything to anyone, it's very, very hard to go bankrupt.
Yeah, and I
think that's a Peter Lynch line or something like that.
Yeah, that's great. And I mean the management team has proven over time to be extremely good capital allocators as well. So you see $140 billion and you just think, if they can allocate that, somewhat effectively, 10-15% per year return or something, you're talking about tens of billions of dollars of recurring, annual revenue that could come out of that if they can find opportunities for that. So that's really where it lies with Google. There's a big opportunity for them to continue to invest effectively if they can do it.
Yeah, exactly. So that's pretty much all I had to say about balance sheet numbers, just to say, obviously made the point that it's a pretty boss balance sheet. In terms of the conference call, there wasn't really, most of it was just regurgitation of the stuff that we were already talking about. There was just a couple of bits and bobs that just I found interesting. So there's currently 5 trillion all-time views on YouTube Shorts. So I don't actually know how that compares to other like TikTok, Instagram Reels. I don't think we don't those get numbers. But 5 trillion, I imagine if YouTube Shorts is at 5 trillion, then those other platforms are at a lot more than 5 trillion.
You'd have to think so.
A lot more.
Yeah.
YouTube Shorts apparently getting 15 billion views each day, as we were talking about before. Interesting stat on the YouTube front: creators that have made $10,000 in revenue in a year I'll say that again. Creators that made $10,000 in the year went up 40% last year. Other words, 40% more creators making more than $10,000.
Wow, so, that's great. That's fantastic.
Yeah, that is very good. And this is why the secret sauce of YouTube. I mean, to get people to make content for your platform, just give them a good incentive structure. Just enable them to actually put their heart and soul into creating content. Make it so that they can do it as a full-time job, and then what do you know? A lot of people out there will start doing it. So
yeah, and I mean, if someone's making $10,000 in ad revenue, you can add if they're smart about it with sponsorships and that sort of thing, then you add a few multiples on that, and that's what they'd be making from the entire YouTube side of their business. So 10,000 might seem, well, that's still not enough, but it really 10,000 in raw ads, especially for the average channel, that's way more views than we're getting on our channels.
Yeah, true.
They're going to be able to activate other revenue streams as well. So that is it's a huge milestone for them to be continuing to increase that.
Mm. Yeah, definitely. So very bullish on YouTube into the future. In terms of cloud, just a little tidbit, the company saw 65% year-over-year growth in the number of cloud deals worth over $1 billion.
Wow.
So that's a pretty impressive stat, although who knows, maybe they just had very few deals over $1 billion beforehand.
they just had 2 deals or something.
I had 2 deals and they added a couple more. So that's interesting. Pichai said the company saw an all-time sales record for the Pixel smartphone, despite all of the supply chain issues, which is promising for that particular bit of hardware. And then the biggest news of all is that Google are going to do a 20-to-1 stock split.
Wow.
Subject to shareholder approval. So each shareholder is going to get an additional 19 shares.
Wow.
So the CNBC article said, were the split to happen as of Tuesday's close, the cost of each share would go from $2,752 to $137.
Wow. Oh my God, it's so cheap now.
So cheap, bro. Yeah, that's crazy. You're getting such a discount now if you buy
95% off.
Yeah.
No, that is interesting.
Not
Yeah.
Not quite the way it works, but
big sarcasm alert there. No, but
I mean, fair enough. What's the share price at now? What were we saying before? $2,960. So it's getting up there.
Yeah, it's probably as high as you'd want to. I mean, there's really no, I don't know. Like, I guess most investors are putting a significant amount of money in, but I guess putting the share price a little bit lower gives people a little bit more flexibility with how they trade the shares, and
I think
a little bit more opportunity for smaller investors as well. But I don't know why else they decide to do that. Maybe it just looks better. Have a smaller number to go up.
Yeah, that's true. That's Google.
Well, there you go. Yeah, so Google had a much happier time. Did they give any? Were they soft on guidance, or were they just talking?
Honestly, I didn't even
maybe
look at guidance.
Look, guidance is irrelevant to our kind of style of investing, but I wonder if they. They're doing so well, so maybe their guidance was strong as well, or maybe they didn't give guidance.
I'm not sure. I'm just trying to squiz through to see any sort of guidance. Yeah, no, I can't say. I'm sure they did give guidance, but I just can't see it. Anyway.
Cool.
Moving on. Should we do Apple or you want to do
no.
I kind of want to hear about Spotify, but
okay.
Should I just fly through Apple?
Okay, do a quick Apple, and then we'll jump into Spotify.
I won't spend long on Apple just because it's the same story.
Yeah,
it's the same story as ever. So of course, remember they reported, what is it, Q1 2022, which actually, if you look at the calendar, is just the last quarter of last year. So it's the same time period.
Stupid Apple.
Yes, just so dumb. Just call it Q4 2021 for Christ's sake.
Just fix it.
Anyway, just do it. It's so much easier. No, we just want to get the year off to a bright start. So, but anyway, record revenue, $123.9 billion, up 11% year over year.
Wow.
Gross margin in products, 38%. Gross margin in services, 72.4%, which makes sense. One, you're making products. The other one, you're just selling software or subscription to software. It really does show you the power, though, the difference in software as a service versus traditional building and selling products. Operating margin of 33%, net income up to $34.6 billion for I'm just going to call it Q4. It makes more sense in my head. Net income up to $34.6 billion for Q4 versus $28.7 billion for the corresponding quarter 2020. So a bit of a jump there. Sales by product category, iPhone was number one, of course. That is quite the bulk of their sales. Up 9% year over year to $71.6 billion. Services was number two, up 24% year over year to $19.5 billion of revenue. Wearables, home, and accessories was up 13% to $14.7 billion. Mac was up 25% year over year to $10.8 billion in revenue. And then finally, coming in, we had iPad, down 14% to $7.2 billion.
They're just so diversified. So many, $10, $15 billion businesses or product lines at least. It's just...
it is pretty crazy.
Yeah, crazy business. Crazy. But
it's a stark reminder that iPhone is very much the number one. Like $71.6 billion of their revenue coming from iPhone versus what, 19.5, 14.7, 10.8, 7.2 from the other product categories.
Oh, yeah.
iPhone is important.
Yeah, and a lot of, the other segments are basically reliant, well, not entirely reliant, but fairly reliant on people having an iPhone. Wearables,
True.
I think you have to have an iPhone, right? And, a lot of the accessories would be iPhone related. A lot of the services would be through iPhone. Although now they've got, Apple, what is it? Apple TV Plus and that sort of thing, and their fitness and that sort of thing. But yeah, a lot of it hinges on the iPhone and that is like a core of their ecosystem.
Yeah, definitely. I was going to say it's like the first point of contact for their ecosystem. You can think of everything else in their ecosystem is better with an iPhone, and an iPhone is better with everything else in the ecosystem. And I guess that's exactly what you want. And that's obviously what they're hinging on. They're trying to build that ecosystem as powerful as possible so people literally can't escape.
Yeah, because I don't think I'm really sucked into the ecosystem, but I have all my computers are Mac. I think they are amazing computers. But I think because I don't have an iPhone, I haven't been sucked into things like cloud storage, using like Apple Mail and Apple Maps and just starting to use everything that Apple produces. I haven't been in any of that. Everything else is just like Google Drive, Google Phone, all of these things. So I think I really do think the iPhone is like where you go into the ecosystem. And then you have like photos through cloud, for example, rather than mine through Google. Yeah. So it's interesting because I feel like I'm not in the Apple ecosystem, but I think they have amazing computers, so I use them. Yeah,
fair enough. Let's talk about the balance sheet very quickly. $37 billion in cash, $26.7 billion in marketable securities. So quite a comfortable cash cushion. $153 billion current assets versus $147 billion short-term liabilities. So not quite as impressive of a current ratio as the other businesses we were talking about before. $381 billion in total assets, $309 billion in total liabilities. So again, not a huge amount, not a huge percentage of, I guess, equity there. But I still don't think Apple's got anything to worry about. But they do have $106 billion in long-term debt, $11 billion in short-term debt. But they're still a financial powerhouse. But it's interesting looking at the differences in the balance sheet. I'd certainly take something like Google's balance sheet much more than, say, Apple's.
Yeah. Yeah, they've definitely moved towards a much more mature business where they're activating a lot of share repurchases, so running down their cash, and then also using debt in order to further activate those share repurchases and dividends. So they're really pulling capital, out of the business at this point, which is surprising because they're still growing at such a massive rate in some of their segments. They're able to have such big growth while also, drawing money away from the business is kind of impressive. So very interesting.
Just lastly, free cash flow in the December quarter was $44 billion, so pretty impressive. And what you were saying before on share repurchases, they did $20.5 billion in share repurchases and paid out $3.7 billion in dividends. So repurchases continue. Anyway, that's Apple.
There you go.
Much the same. You pretty much summarized it.
Yeah.
They make a lot of money. They give a lot of their cash back to their shareholders.
Yep.
Done.
That's it.
Yeah.
All right.
Yeah.
We'll hear
Spotify.
Let's hear from Spotify. Yeah, we don't normally do Spotify, but there's a little bit of controversy going on at the moment with the company. So I thought we'd take a look at it. Revenue came in. This is all in euros, European company. Revenue came in at 2.7 billion euros for the quarter, up 24% year over year. And that was driven through their free user base as well as their premium subscribers. So free users generate revenue through their ads, and then premium through paying a subscription. The monthly active users overall was 406 million, up 18% year over year. Their premium subscribers reached 180 million, which was up 16% year over year. So that's pretty impressive in of itself. I mean, if you kind of think of it, I think it's priced fairly similar to something like a little bit less than something like Netflix. So having 180 million subscribers on recurring revenue is
impressive.
Is really something. Average revenue per user for the premium subscribers increased 3% for the quarter. So small price increases there, a little bit of foreign currency exchange in that as well. And the business is not profitable yet. So operating loss of 7 million euros compared to 69 million euros last year. So they're still operating a loss. They're investing in their future. They're pumping a lot of money into things like podcasts and that sort of thing, buying, exclusive rights. We heard about, I think it must have been last year or maybe late the year before, where Joe Rogan got that $100 million+ deal with Spotify. So
just a little bit of coin.
It is crazy. How much that deal went for. But that's an example of Spotify, basically buying the rights to a huge, the biggest podcast, in order to reap benefit from that over time. And some of that is going to be seen in their in their operations, in their income statements. So that's why they're operating at a loss. But podcasts, which is going to be a big push for them over time, particularly if they're looking to activate more revenue growth, they're probably going to need to find a way to monetize podcasts in a more meaningful way. Podcasts reached 3.6 million podcasts in the quarter, which was up 400,000 from the previous quarter. So a lot of podcasts coming out. We've got a lot of...
That's crazy.
We've got some competition.
Yeah, I reckon.
Which is it's kind of mind-blowing. 3.6 million podcasts. So there you go. That's the landscape for podcasting at the moment. But what I did want to talk about is, of course, there's quite a bit of controversy that's happened over the last week with Spotify and Mr. Joe Rogan. So earlier in the week, a number of musicians, now there's quite a lot, that have removed their music off Spotify. And this is in response, it's kind of a boycott of Spotify in response to so-called COVID misinformation being aired on the Joe Rogan Experience. And I just say so-called because Rogan would argue, and he put out a statement, he put out a little video, he would argue that there's two controversial episodes that are kind of in question, where there was essentially information being talked about that is not supported by medical consensus. So a lot of people call it conspiracy theory or alternative views or whatever it is. But both of the people he had on are very well published medical professionals. So that's kind of the two sides of the coin. It's like one side, they're medical professionals giving a different opinion. The other side is it goes against medical consensus. So it shouldn't be there. We need to only, allow content that agrees with medical consensus. So, some people disagree with that. Some people agree with that. But of course, Spotify, as I alluded to before, with their $100 million deal with Joe Rogan, part of that deal allows Rogan to have complete creative freedom.
Right.
They're not going to be taking down any of his episodes, or else that deal blows up. So very interesting situation, because it's kind of this clash between, is Spotify should they be curating content on Spotify, or is it just a platform? Is it just, if you have a podcast and you go on.
Sorry, you go.
No, I was just going to say, is it just a platform where, there's going to be a lot of different views, some you disagree with, or should they be going, nah, we can't have that on the platform. That's unacceptable.
Yep. Isn't that the issue for literally every social media platform as well? It's the issue. It's like, what do you do? It's the easiest way is to throw your hands up in the air and say we're just the platform. However, then you will get people boycotting your service, this and that, sexism or racism
for podcasting at the moment
on your platform, and then that just reflects poorly on your platform. So it's like, here we go. I guess we have to have some sort of content community guidelines and that sort of thing. And then it's like, then the other side of the equation says, you're starting to censor all the content. And that's the big question, is how much how many guidelines do you have? How much censorship? What gets banned? What gets allowed? It's just tricky.
Yeah.
It's just tricky. However, I will say that I did listen to, I think, a couple of minutes of what Joe Rogan was talking about. I haven't followed this super closely, but it does seem like he did put some thought into what he was doing before he did it, by the fact that he didn't just get some lunatic off the street to come and shout from the rooftops that, Bill Gates is controlling you through vaccines. He actually got extremely well-published medical professionals to come and give their opinion. And I think the point that he made, which made me open my eyes, is like, there's a lot of information that a couple of months ago we would dismiss as misinformation that has slowly over time actually now been accepted as, accepted as fact. And I was like, yeah, okay, that does make sense. I mean, we were thinking all sorts of different stuff if you rewind the clock 2 years ago. It's a tricky situation. Yeah, it's a tricky situation.
The phrase misinformation it's a weird one. It's strange when you're talking about things that are ongoing and developing. I certainly don't agree with the views that were shared on those 2 episodes. But I'm also not a medical professional, and my opinion would be, it's difficult for me to challenge any of the claims on the ones where he has people on where they agree with medical consensus, which he had a number of people on that argued back against him, or the other people. Who am I to know? I honestly prefer to listen to as many opinions as possible and to just kind of reach my own conclusion. But
what were these podcasts even about? I didn't listen to them.
So
what are the views that are so in question?
Well, okay. So there's some views in regards to it's like a heart condition. I don't know the name of it. There's a heart condition,
like myocarditis.
Yeah, I think it's called that. That occurs at a certain rate in particularly young men who take the vaccine. And the pushback from medical consensus is that those same diseases occur at a higher rate if you get COVID for young men.
Oh, okay.
So the pushback is, even though you do have an elevated risk of these diseases, and it was 6 in a million or something. So we're talking talking about right on the fringe, right? Anyway, but yeah, the argument was, if you were to get COVID because you didn't have the vaccine, then your risk would have been higher anyway. And that's kind of where the argument lies. So that was kind of just one of the key points. But yeah, look, I'm not a medical expert. I don't know, but I like listening to different opinions. I don't know. I think people fall into different categories. Some people think we should limit what people can hear because it's dangerous if they hear it. And certainly there are people who just take what they hear for, as gospel, regardless of, they don't think critically about it. And that is, a concern. But I still fall into the camp where I would rather be able to listen to every opinion and let people form their own opinion and let people push back against things. But anyway, I mean, the artists have every right to pull their music off Spotify, and that's also their choice. So I think that's fine. I don't know who has more power here at this point. I guess it depends on how many people pull back off Spotify. Like if a lot of artists pull back, like 20% or something, and the service got materially worse for consumers, then they have more power. But at this point, it seems like Spotify has got all the power. Yeah.
I think it's just going to blow over, to be perfectly honest. No one's really going to care about it in a week's time.
Yeah.
But interesting. But it's the age-old debate. The age-old debate that everybody faces. How much censorship? What can go on? What do we have to remove? Backlash from both sides of the equation. It's just very difficult.
What's that? I'm just hearing we can't have this discussion on Spotify. We've got to cut this bit, Brandon.
Oh no.
Yeah, sorry.
Oh, did you just get a call from the CEO?
No, just from the Fed. Yeah.
Oh, okay.
Yeah.
Oops.
Yeah, they're not happy about that. So, yeah. We're going to have to be pulling that back.
We're going to get pulled.
Sorry, guys. You won't be here in this episode. So,
Anyway, should we wrap things up? We've been going for an hour.
Let's wrap things up.
Wow, we did cover a lot. That was good. We got through 4. What did we get through last week? 3.
2, I think.
2, I think. That's right, Netflix and Tesla. Anyway, there's just so much to talk about, man.
Goodness.
It's kind of interesting. Every business has its own little narrative that we need to keep up with and follow. It's very interesting. But yeah, it was the big advertising giants today. I wonder what we'll have next week. I got no idea what earnings are coming out. over the next little while.
I think we might get Disney next week. I think it comes out on Thursday morning. So
Disney would be a good one. I like looking into Disney. Maybe I'll look into that. But we'll figure it out, and keep saying it. We will get to. We've got a backlog of questions, so we will get to some of them. We're hoping to get to some today, but we just ran out of time, unfortunately. So we will make a point to get to some Q&A next week on next week's show.
Yes.
But keep sending the questions in. Go to the YouTube version of the podcast. Drop us a comment. Ask a question. We'll bring it in. Ask it on the podcast. We'll chat about it. So thanks very much, guys. And thanks always for listening. We do appreciate it. Hope you enjoyed the episode. Thanks, Hamish, for joining me. Thanks to Sharesight, as always, for sponsoring. And with that said, we'll see you guys next week.
See you guys.